Welcome to the deep dive. Ever stop and think, what exactly does the tax man consider income?
Uh-huh.
That's what we're digging into today. Gross income. We've
Gross.
looked through the sources to pull out what you need to know.
Right. And the starting point, well, it's really broad. The code just says all income from whatever source derived, unless, there's a specific rule saying it isn't income.
All income. Like anything.
Pretty much. Think about this. Say you find, I don't know, $4,000 hidden under a floorboard. If you can't track down who it belongs to, technically, that's income for you.
Wow. Okay, so it's a wide net. So if it's not just cash, how do they figure out the amount?
Good question. Cash is easy. It's just the amount you got. But if you get paid in property or maybe services, then it's about the fair market value.
Fair market value.
Yeah.
What it's worth.
Exactly. What it would sell for on the open market. Say you do some work, and instead of cash, you get a car worth maybe $3,000. That $3,000, that's your income from the deal.
Got it. Now, the sources mention realization and recognition. That sounds a bit like jargon. What's the difference for us?
Yeah, they're key concepts. Realization is basically when you get something of value. That could be cash, property, services, or even just a measurable change in, say, an investment you hold.
Okay, so realization is the getting part.
Right. Recognition is when that income actually goes onto your tax return. So imagine you bought some stock for $100. It goes up. It's worth $150 now.
Nice little game.
But you haven't realized that $50 gain for tax purposes yet, not until you actually sell the stock. Only then do you recognize it and potentially pay tax on it.
Oh, okay. So realization first, then recognition when you report it. What about the timing? Does it always count when the cash lands in your bank account?
Not always. There are two main ways, really. Accrual and cash. Accrual is more for businesses. Often following JAP rules, you record income when you earn it, even if you haven't been paid yet.
Okay, but for most individuals.
For most of us, it's the cash method. Income counts when you actually get it, or when it's made available to you, what they call constructively received.
Right, like a check you just haven't cashed yet. Okay, let's zoom in on the big one.
Yeah.
Salaries and wages. It's not just the number on the paycheck, is it?
Definitely not. It's all the money, sure, but also the fair market value of any property you get from your employer.
Property. Like what?
Could be anything, really. Even a bargain purchase counts. If your employer lets you buy something for way less than it's worth, that discount, that's usually considered income.
Huh, okay. What about all those job perks, fringe benefits? Are they taxed?
Generally, yes, unless there's a specific law that excludes them. A classic example is using a company car for your own personal trips. The value of that personal use, that's taxable, added right to your wages.
Makes sense? Anything else like that?
Oh, yeah. Employer contributions to a Roth 401k. Those are taxed now up front. That's the trade-off, for getting tax-free withdrawals later on.
Right, the Roth trade-off.
Yeah.
What about life insurance through work? I know lots of people get that.
Good one. For group term life insurance, the premiums your employer pays for the first $50,000 of coverage are usually not taxable to you, assuming it's a non-discriminatory plan.
But only the first $50K.
Correct. If the coverage is more than $50,000, the cost of that excess coverage, based on IRS tables, gets added to your taxable income.
Okay, good to know. Now let's flip to the good stuff, the non-taxable benefits. Sounds like there are quite a few ways to get value without increasing your tax bill.
Absolutely. And some are really significant. Think about employer-paid health insurance premiums. For accident, medical, health insurance, those premiums your employer pays are typically excluded from your income. That's huge for a lot of people.
Yeah, that's a major benefit.
And generally, if the plan reimburses you for actual medical expenses or pays out for, say, losing a limb, those payments are usually tax-free too.
Okay. What else is typically tax-free?
Well, there are de minimis benefits, things so small that accounting for them is just impractical, like occasional personal use of the company copier, maybe.
Tiny stuff.
Exactly. Then there are meals and lodging. If your employer provides them on their premises for their convenience, they can be tax-free. For lodging, it usually also has to be a condition of your employment, like you have to live on site.
Right, like a building superintendent or something.
Precisely. Also, employer payments for your education expenses up to $5,250 per year can be excluded. That's a nice perk.
Definitely. Any family-related ones?
Yes, there's employee adoption assistance, which has a pretty high exclusion limit, though it phases out for higher earners, and dependent care assistance, helping pay for childcare, up to $5,000 usually.
Really?
And if you work for a university, qualified tuition reductions can be tax-free. For undergrad, it's often fully excluded. For grad students, usually only if you're doing teaching or research.
That's a lot of potential exclusions. Anything else common?
Sure. Qualified employee discounts, getting a discount on the company's products or services, there are limits, but it's often partly tax-free.
How limited?
For merchandise, it's limited to the employer's gross profit percentage. For services, it's usually up to 20% off the fair market value. Also, employer-provided parking or transit passes, up to a certain monthly limit, are usually tax-free.
Okay, parking and transit.
Right. And don't forget contributions to traditional non-Roth retirement plans, like a regular 401k. The money your employer puts in, and usually the money you put in pre-tax, isn't taxed in that year. You pay tax when you take it out in retirement.
Gotcha. And FSAs, flexible spending arrangement.
Yes, FSAs. They let you put aside pre-tax money for specific things like healthcare or dependent care costs. There's a limit each year, and the big catch is the use it or lose it rule.
Meaning you lose any money left at year end.
Usually, yeah. Though some plans now have a short grace period or let you carry over a small amount to the next year. But you have to be careful planning your contributions.
Okay, so wrapping this up, the big picture seems to be gross income starts really, really broad.
Mm-hmm. Everything's potentially income.
But then there are all these specific carve-outs, these exclusions, especially for common employee benefits.
Exactly. And knowing those exclusions is key. It can genuinely impact your tax liability, how much you owe.
So really, as you look at your own pay and benefits, it pays to understand how each piece is treated for tax purposes.
Huh.
That perk might be great, but is it tax-free?
Absolutely. Think about the different forms of value you receive, your salary, bonuses, maybe stock options, health insurance, that parking spot, and consider if any of these exclusions we talked about might apply. It's definitely worth checking the details of your own situation.
Great advice. Thanks for diving deep with us today.